Okay, guys, hi. Okay, great. So, IAS19 employee benefits. Really, I'm just going to go straight to focus on the defined benefit plan. And that's what the focus is very much about. And in effect, what we have here is that we have a guarantee from employers to provide a particular level of pension benefit to employees upon retirement. So, in effect, they are creating a liability straight away. Right, and they need to recognize an expense in effect to enable this liability happen. So they are making a promise to pay in the future. That's the key point. So in effect, if this is to be recognized, if we're talking about something that's going to be paid in the future, which will be variable all over the place with all the people you're working with, in effect, we need to recognize the present value of that liability now. That's task one. So again, like I say, if the entity has an obligation to pay extra for, yeah. So the key point here is we need to recognize the present value of that liability now. You can imagine that trying to do this on your own might be tricky. So you enlist the advisory of actuaries who will then be able to tell you year on year what the changes to your liabilities are that you have made a promise on, because people live for longer, people live for shorter, people have all kinds of illnesses, whatever. Then you have new people joining. So that's the task here. In the meantime, what happens is that the organization itself will take any money being put into the fund and investing that, if you like, in some plan assets, so that those assets will provide for, if you like, the payment of that, as opposed to just leaving it in the bank, because they probably get a better return that way. So that's the first thing to highlight. Let's carry on. Let's cover everything. So what do we? Oops, sorry about this. So what are we talking about here? So the key point here is the first thing we do. The way this is the standard requires, IAS19 requires that what we see is a net deficit, a net balance on the liability and the asset. So sorry, yeah, that's what I was looking for. A net deficit or a net asset, depending on whether or not the plan assets are more than the deficit brought forward, and then we act. So when I say we act, first of all, because we've found the present value of this liability, right? Like any liability, as we go from one year to the next, there will be an interest component. So we have a net interest component, which is really the unwinding of the liability, plus also the interest gained on any plan assets, all kind of mixed up together in there. So we have that net interest component. Then, of course, we have the service cost. So the service cost, very much, you have new people joining the fund. The actuaries will tell you any changes that have happened. But that's really the service cost, the increase in the present value of the obligation arising from the employee's service. So they've done some work, and so now you will give them some more money again, if you like. So you have your existing liability done with, and you have the actual work taking place and new people joining. Service cost. Now, this goes through the income statement. This is an expense. If you like, this is an expense. So these are all expenses, this one and this one. And then you also have any amendments, as you can imagine. It's pretty much a change to a liability. So we have amendments coming in, people coming in. There might be curtailments, which means you're reducing the benefits you intend on giving, which in a way you're therefore reducing a fall. You're having a fall in the liability. You might be giving more out there. You might actually be giving them more benefits in the future, so that's a bigger expense to hit you. And then, of course, we have, so all these will go through the income statement. So in terms of recognition, what we're talking about earlier on, it's important to know where that goes. Contributions into the plan, so you have, if you like, money coming straight into the plan. So this is going, if you like, into the assets, so to speak, and so this is not coming onto the income statement. And then when we pay out benefits, in effect, we are paying the benefits out of the assets and in effect reducing the liabilities at the same time. So we see no effect on the income statement as well for these two. So where are we? Here we are. So I took here. This is really the I was talking about. This is the contributions made into the plan. The entity will make regular contributions to the pension plan. These contributions will be invested, and the investments will generate returns. These assets must be held at their fair value. So we're all talking about fair value. Holding everything here at fair value. So where are we? So key point here is in terms of the conceptual framework, these are long-term in nature. It is inappropriate to recognize. So there is a revaluation. Any revaluation to the plan is recognized within other comprehensive income because the plan itself is a long-term plan. So it's inappropriate to recognize any short-term fluctuations in the profit or loss. So this is what I was saying. On the statement of financial position, entity offsets its pension obligation and its planned assets and reports the net position. If the obligation exceeds the assets, there's a deficit, and of course the other way round as well. And our actuaries help us out with that final value. Now, there are some issues, of course, as you can imagine. There are some issues, and I thought I had the issues. I'll just pause and find what the current issues are. If you give me a second. Sorry, that was in a separate spreadsheet. So these are the issues here. So key point here is that the reporting entity must determine the current service cost for the room. So really the fundamental issue here is this, right? That at the beginning of the year, the actuaries will tell us what the current service costs are, and they will tell us based on, because you see, we would have gone to the actuaries and we wouldn't have told them at this point, we wouldn't have known if there were going to be any changes during the year. And during the year, there might be changes to the interest rates that we're working with, if you like. And there might be movements during the year that we wouldn't have known at the beginning of the year when we meet our actuaries, you see, because we use the interest rates given to us at the beginning of the year to work. Now, if we want to good faithful representation really means we should update our actuaries with changes during the year, interest rate changes, changes in, if you like, things that affect the current service cost, so that we can then recalculate the net benefit and the net defined benefit liability. But there's a matter of cost. How often are we going to be going to the actuaries to get them to give us this information? So that's a major criticism of this standard. So yes, income statement, other comprehensive income. And again, like I say, I think that's the main criticism. If there are updates during the year to determine the current costs and the net interest periods, we ignore these assumptions, and that is inappropriate. But if we put them in, if we did get in touch and had the actuaries updating us regularly, this will give a much more faithful representation. And that's pretty much it for the defined benefit plans.